Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today we're going to talk about using margin as a personal loan. And I thought of this topic because I'm actually in this particular situation right now. Over the next couple months, I'll have a teenager with his own driver's license, and we need to get another car so that this person is not always using mine. Now, when I say buy a teenager a car, I'm not talking about like a brand new Jeep Wrangler here. We're talking about reliable transportation somewhere in the neighborhood of $5,000 to $10,000, depending on what kind of deals are out there. Now, with that price point in mind, in my particular situation, it makes a very good use case for using margin as a personal loan. The goal here for me would be to put this money back into the brokerage account in the next 3 months or so. Generally speaking, when I use margin as a personal loan, it's really just for a quick infusion of cash, anywhere between 3 to maybe 12 months at the absolute longest. All right, so let's jump in and talk about how the math and the whole process on this works. All right, the first step is understanding how much margin you have available to your name. I'm just going to use my portfolio tracker here in Seeking Alpha to kind of explain it to you. As of right now, the total is displayed as $73,000, basically $74,000 worth of equity value. Now, the first thing you got to do is make sure that you've applied for a margin account in your brokerage, or else you will have none of these options. I use Ally Bank for my investing account, and the process was as simple as choosing it out of a drop-down menu, filling out a form, and then, typically it's going to take a business day or two to get fully approved. The next step is trying to understand how much money you have available to you to use margin as a personal loan. And in my experience, it's generally 50 to 60% of your equity holdings. So if I'm here at 74,000, I'm guessing off the top of my head that I have, between $37,000 and probably $50,000 worth of margin loan that I could withdraw. Now, with that, I typically do not withdraw anywhere close to the maximum amount, because the maximum amount actually adjusts every day based on the performance of your stocks. And we know where the stock market is right now. And as a matter of fact, I'm minus 34% just on this stock tracker. If the market keeps going down, and let's just pretend we had a huge crash tomorrow, and this number that's 74,000 went down to 50,000, then all of a sudden the amount of margin that I qualify for is going to drop significantly, right? Somewhere into that 25,000, 30,000 limit. So if I took out all the money on yesterday's limit and now the limit is lower, that's where you get into what they call a margin call. And you either have to sell some of your stocks, which, right now in 2022, it's a pretty bad time to sell stocks because so many of them are down, right? Or the other option is you can deposit cash into your account. So one of the little rules that I do on the personal loan side is I try to never withdraw more than the cash amount I might have in savings to quickly replenish if something bad were to happen. Now, some people might think that that's a little odd, right? So let's pretend I have $10,000 in a savings account and I want to buy the $10,000 car, right? Why would I use margin with interest when I could just use the $10,000 that's sitting in the bank account? And at least from my perspective, I like to have the actual cash sitting in a savings account where it can be accessed quickly. So one scenario that would be horrible, but just to think outside the box here, let's just say you had an insurance deductible. Something happened to your house, a tree falls on your house, and you need $10,000 insurance deductible in order for your insurance company to pay out the amount, right? Well, that's where emergency savings come into play. And that's why I'm always careful to keep that emergency savings cash pile untouched, except for the most extreme of circumstances. All right, so now you should understand a little bit more about the basics behind a margin loan, but how does it actually work? And it's really as simple as transferring money from your brokerage account to your personal bank account. Fidelity's website has a pretty good example. Everybody's account dashboard is going to look a little bit different, but if we try to zoom in this picture a little bit, it's a little blurry. But bottom line is you are going to see some sort of tab in your portfolio that says amount available to withdraw. And you can see down here, this particular person happens to have $70,000 in cash in their account. So that would be the first amount of money that comes out. But let's say they wanted to withdraw $80,000. So with that, it would remove all their cash, and it would also remove $11,000 from their borrowing margin. Now, obviously, if you're fully invested and you don't have any cash in your brokerage account, it'll just pull directly from the margin. So once your margin account's set up and you see the amount available to withdraw that includes the margin, it's really just as simple as transferring out whatever amount of money that you want. And then from there, you're on the clock in terms of the interest rates. Now, what about those interest rates? Keep in mind that I'm on Ally, and they have this little interest rate chart. I don't know how accurate it is for these other TD Ameritrade and E-Trade, but for the amount that I was talking about here, $10,000 for the car, it's 8.5% interest. Now, at 8.5% interest, you're obviously significantly lower than any sort of credit card interest rate that's going to be 15, 16%. And of course, we're talking about cash here. So if you were to use a comparable credit card, you would be on the cash withdrawal interest rate, which typically is higher, at least from my experience. But you're certainly not going to find a system that is easier in terms of forms, fees, etc. Now, for my example of using $10,000 and trying to pay it back between 3 and 6 months, how much is that going to cost? Well, I'm using this margin interest calculator. We have a $10,000 loan amount. We know the margin rate is 8.5%. And the number of days the loan is held, I did 120, which is 4 months. And the total margin interest for 120 days would be $279. So I will pay Ally Bank the equivalent of $279 to get this $10,000 in my bank account for immediate use. And as long as I pay it back within 120 days, this is the extent of the fees that I will pay. And as far as paying back the loan, how do you do that exactly over 120 days? And the answer is actually pretty simple. You just make deposits from your checking account or your outside account, whatever funds your brokerage account. You just make deposits until your cash balance reaches at least the point that you borrowed. So obviously here I borrowed $10,000. I have to replenish my account up to $10,000 before the interest charges stop. Now, the cool thing about it is there's really no timeline that you have to do this. Obviously, you're paying interest, but no one's going to call you, let's say, the first of next month and say, please deposit $2,000. You pay back into the account basically at your convenience with the understanding that the longer it takes, the more money you're going to lose in interest expenses. The only catch to that, of course, is that your stocks need to maintain a value that allows you to have $10,000 in margin loans outstanding, right? So let's just pretend you had $20,000 in equities at the time of your margin loan, which was for $10,000. If the market were to collapse, or, just your stocks were the ones to collapse, and let's just say that it came down to $7,500. Depending on the structure of your account, you could get the call that, hey, we need $2,500 in cash deposited to your account. You can either sell some of the stocks in your account to fulfill that, or you can deposit money from an outside source into your brokerage account to get back to par. Okay, so there's a lot of jokes and warning signs out there about margin on the internet, and I would say probably most of them are true, but I would also say that most of them apply to buying stocks or securities with your margin money. That is a much different game than simply using margin as a personal loan over a short-term period. All you're doing in this case is using collateral, aka your equities, to borrow against with the intent of paying back. Really not that much different than a home equity line of credit, but instead of putting a lien on your house, the bank just has essentially a controlling interest in the shares on your account. You can still sell them, you can still trade them, but depending on where your cash levels get to and your portfolio value falls, they may ask for more money in the future. And I would say the one thing that gets looked over all the time in terms of margin and using margin as a loan is just the stability of your equity account. If you have relatively safe equities, and I'm talking about SPY, QQQ, VOO, ETFs like that could certainly go down in the short term, but I would just say it's incredibly unlikely that they would ever go down to zero, and I would say it's incredibly unlikely that names like that are going to lose 50%, although technically the potential is there. So if you have a brokerage account that's mostly ETFs or just super high quality stocks, maybe it's a Microsoft, Home Depot, whatever your definition of a high quality stock is, right? Stocks that have limited risk to the downside, then you can probably feel pretty good about using margin as a personal loan, particularly if you're only using a slice of that margin availability to make a short-term purchase. All right, guys, so that's a quick use case for using margin as a personal loan. It's a situation that I actually find myself in right here with a potential teenager driver coming into the household. But there's literally dozens of use cases. Some people use it as a bridge loan to put a down payment on a house, on a new house, while they're waiting for their old house to sell, and then they replenish the funds after the transaction. You could use it to help you plan a wedding or a vacation. The real key is to just have some sort of time frame. In my opinion, 3 to 6 months is about right, where you are going to pay back this money. And then in that scenario, assuming you're just using the sliver of your available margin, you should be fine. Okay, let me know if you have any questions about brokerage margin loans. I'll do my best to answer them. And let me know if you've got any fun stories on using margin, as a temporary cash infusion to get something done. Sure, it'd be helpful for the other viewers as well. And before you go, check out my description for a special offer on Seeking Alpha Premium. You get a free trial. You get 50% off the price. A lot of good things. If you're new to the channel, I use Seeking Alpha Premium all the time. Hope everybody's doing well, and we'll see you on the next video.